Aaron Gibbs right now, the Main Street Asset Management CIO. Aaron, there are a lot of numbers in this employment report and a lot of numbers to look at the averages. The one that was the most telling to me, the good news of wages running at about a 5.5% clip, not bad. Unfortunately, the cost of things that people want to buy with those higher wages running even higher and faster at 8.5%. That's not good.
No, it certainly isn't. And, I think we can delve into where the wage growth is. I think there are a lot of improvements, particularly on those that are making less money, that the wage growth is higher. But certainly, I think what we're all really hoping for is that some of these inflationary pressures will eventually subside, the supply side, and eventually the wage growth and the inflation will meet together. But right now, it does not look good. So
when you say they eventually meet together, that means what the Federal Reserve has been doing right now, Aaron, you've been reminding of this through this cycle that's just started, really, it is raise rates enough to at least match whatever is happening on the inflation front. So right now, it's got overnight bank lending rates. It's a little arcane, but at around 0.75 to 1%. But we would conceivably have to get that up to 5%, actually more, just to be even with this. And that's going to be disruptive, isn't it?
Absolutely. And so what the Fed is betting on is that inflation will come down, that some of the supply chain issues, and I know they were wrong about it being purely supply chain, but that is part of it. It's not completely wage growth, that those will be alleviated. That'll bring the inflation down. And as we keep rising with higher overnight rates, that other inflationary pressures will diminish and slowly converge. And that's the idea of this soft landing, that everybody has their fingers crossed, that sort of your inflationary pressures lower as you increase your rates, and you don't have to increase the rates up to 5. Hopefully, their target is around 3.
Right.
And that's what everybody's fingers are crossed. But certainly that's what we see, that investors are nervous. That is not what's going to happen.
This all happens with the backdrop of mortgages that are getting pricier. I mean, age and perspective is everything. But for a lot of folks who didn't know double-digit anything when it came to borrowing rates, we're now up to about 5.25% on a 30-year fixed mortgage. So that's added to some concern that housing's going to get hit. Do you think housing gets hit?
Yes, and we've seen that a lot of those indications, both in the real estate bond market and real estate stock market, that their expectations that are very much so that these prices are going to come down. Some feel that it's healthy because some areas were considered a little too high, but definitely I think the housing prices absolutely are going to take a slowdown, and we may see, there's so much supply demand. I think, still people are going to be able to build houses and sell them, just the prices may be a little lower.
Aaron, what do you tell people who look, if they haven't sold throughout this, they're looking at big paper losses, they're scared. Maybe some investors out there had bought Amazon and Apple and seen their, performance just go at a torrid pace. And they're tempted. Maybe I just got to get out of this. Maybe this bear market takes hold, and I'll have even less than I do now. What do you tell them?
So it certainly is particularly hard, not just for the people that have bought Amazon, but even investors who were in more defensive assets like bonds. Those bond prices have come down. So when I'm talking to investors, I'm freely talking to people who have their safe haven is going down almost as fast as their riskier stocks have gone down. And so this coupling of both the safe haven and the more riskier assets is really hard on investors' nerves. And you see that in the market. There's a lot of negative sentiment. So for some specific stocks, I think that, the high valuation tech stocks, you may want to take those losses, be able to carry them and use them against your gains going forward. For other assets that are higher quality, I would say, look, we're just in this massively fearful environment right now. We have to wait for the Fed and inflation to kind of play out. And it is better to just hold it for the next 6 months rather than come out. So, overall, as a long-term investor, I'd say stay in. I know it's very hard, but certainly for very stock-specific in those technology stocks, I might say you might want to take those losses and use them for future gains.
And again, long term to you, because for me, you're very young, Aaron, but for me, it's like lunch on Monday. I assume you're talking a little bit longer time frame.
Yeah, a couple of years, several years, where you're not pulling out the cash today. Yes.
Understood. Aaron, thank you. Have a wonderful weekend. Aaron Gibbs following all these market developments. We'll be talking to the White House.